The first atomic bomb was dropped on Hiroshima.
Over humanity!
The fires of frustration and discord are burning in every
Let us
city.
not forget for a moment the toils and efforts that lie ahead.
They say that those who forget their history are condemned to repeat it. This is the History Lessons Podcast with certified financial planning practitioner Patrick Huey, author of History Lessons for the Modern Investor, and your guide to financial wisdom in the past, present, and future. You ready? Good. Let's get historical.
Historical? Yeah, for sure. This is the History Lessons Podcast for the week of 10 June 2024, and I'm Patrick Huey, author of History Lessons for the Modern Investor. And if you're a modern investor seeking some historical perspective right now, you're in the right place. And oh, by the way, you're not alone. This week, we'll be talking about schools out, lessons in empire, and investment reviews.
But first, the news.
Now, school is out for summer, and while no gold stars were given out last week, the data did have a positive summer vibe. Let's start with non-farm payrolls. Like the mercury climbing on a hot June day, non-farm payrolls sizzled in May, surging by 272,000 jobs, much better than the expected 180,000. Meanwhile, total hours worked went up by 0.2%, and over the year, hours worked are up 1.3%. Summer vacations, well, that's just nonsense. Workers are hard at it as summer arrives. Average hourly earnings saw a bump of 0.4% in May, and they're now 4.1% higher than last year, which is actually outpacing inflation. The labor force participation rate dipped to 62.5%, while the employment rate slipped to 60.1%, and that, friends, made the unemployment rate tick up to 4.0%, its highest since January 2022. So wait, are we working hard or hardly working? Next was the ISM Non-Manufacturing Index. That index sprang back to life, reaching a 9-month high of 53.8 in May. Business activity caught the perfect wave, rising to 61.2, which matches the best level in 18 months. New orders climbed to a solid 54.1, marking the 17th straight move above 50. On the chillier side, the ISM Manufacturing Index was a rainout, falling to 48.7 in May, and that index has been in contraction for now 18 of the last 19 months. Manufacturing in America is still no picnic. Last up, the European Central Bank and the Fed. Since last August, the ECB and the Fed have been hiking rates together like synchronized swimmers. But the ECB made a solo splash last week, cutting rates. That's right, cutting rates by 25 basis points to 3.75%. That move is raising eyebrows since inflation in Europe has stabilized since February, staying below U.S. levels. Markets are now pricing in a 58 basis point cut in the Eurozone rate, and as much as 39 basis points in the U.S. by year end, which is nice, but the Fed seems determined to keep rates high until inflation cools off to a more comfy 2%.
Interest rates are rising, and your annuity purchased in the last decade might not be keeping up, which means your financial plan may be falling behind. So if you own a deferred annuity, fixed, indexed, or variable worth more than $250,000, now is the time to review it and make sure it is doing all that it can for you and your financial plan. Let us help you keep your retirement on track. Introducing Victory Independent Planning. VIP turns complex financial matters into clear and confident solutions, so you can relax and enjoy retirement whenever it arrives. Get the Annuity Review Kit now. This complimentary kit includes a variety of checklists, resources, and ebooks to review the fees, features, and flexibility, or lack thereof, in your current annuity contract. It will even help you assess your overall investment goals and the people who are offering you advice. Get the kit today, because you can't teach an old annuity new tricks. To learn how VIP can help you review your annuity, click on the link in the show notes or go to victoryindependentplanning.com. That's victoryindependentplanning.com. Sign up for peace of mind today.
Alexa, charge the Wayback Machine and set it for 1916 AD.
Charging Wayback Machine.
On June the 10th, 1916, the Great Arab Revolt against the Empire of the Ottoman Turks begins. You see, on the eve of World War I, the Ottoman Empire was a relic of centuries past, pretty much outdated and providing little value to its citizens. And revolutionaries stumbled upon an effective communicator who helped them create a grand strategy and kept their motivation up when things were wrong. His name was T.E. Lawrence, and he penned a quasi-autobiographical account, The 7 Pillars of Wisdom, about his service. After his death, it became the basis for the movie Lawrence of Arabia. And a quote from the book, "All men dream, but not equally. Those who dream by night in the dusty recesses of their minds wake in the day to find that it was vanity. But the dreamers of the day are dangerous men, for they may act on their dreams with open eyes to make them possible." Allow me to translate for investment purposes. Don't become a relic. Today, the shifting sands of the financial industry have many investors revolting against investment models that are outdated and provide little value. Dreams are important. They give us a place to strive for, something to work towards. But they're meaningless unless we have the strategy and tactics to make them real. And this is a time where the tactics are especially important. Why? Well, since bottoming in October of 2022, the recovery from the most recent bear market in stock and bond markets has been uneven, with more conservative options lagging more aggressive ones. Bonds, represented by the Aggregate Bond Index, or AGG, have had a terrible time as interest rates have risen and stayed higher for longer than expected. And yet, opportunities abound with other instruments like T-bills. Making that shift in tactics is important for making your dreams possible, so you can dream on.
Wayback Machine disengaged.
Returning to the year 2024.
Finally, this week, it's on to the mailbag.
You've got mail.
And this week's question of the week was, hey, what should I look for when I review my investment accounts? And remember, if you're listening to this podcast and want to see the visuals referenced during this segment, please join us on Substack, where you can view the video version of this podcast, or on YouTube, where you can do the same. Now, when I am talking to people who are not yet clients, they'll occasionally ask me about their own investments, what they should be looking at, what they should be looking for, how they should be reviewing their own progress. So today, what I want to present is a list of 10 things to think about, and then we'll go through and take a look at one of the checklists we offer if you want to take a look at your own investment planning. So reviewing your investment accounts regularly is crucial to ensuring your financial goals are on track, but it's not the only piece. So let's look at what you need to look at, not only in your investments, but in your bigger planning activities as well. So 10 things to consider. First is the one that people always focus on, and that is performance evaluation. And yes, it's important to evaluate performance. You need to look at some benchmarks to assess your portfolio's performance against and I'm going to emphasize a relevant benchmark to gauge your success. What is a relevant benchmark? Well, it's going to highly depend on what type of investor you are and what type of planning you've done to get to this point. Now, that's the big picture. You want to look at your portfolio versus a benchmark to gauge how you're progressing. But you also need to go a little bit deeper and look at individual asset performance as well. Just make sure that everything is performing the way you think it should be, based on the planning you've done to this point. I like to use some simple benchmarks a lot of times with clients based on their risk tolerance. There are plenty of them out there now where you can find a conservative or a moderately conservative or an aggressive index or index fund to track right alongside your portfolio and see how you're doing. Check out my website. You'll find some there as well if you want, at victoryindependentplanning.com/compared to what. What that gives you is a snapshot of stocks, bonds, moderate and conservative portfolios all in one chart. Second thing to think about is the allocation of your assets. Are you properly diversified? Are you rebalancing? Are you required to rebalance? Do you need to rebalance? Or is that already happening based on some trades that are going on throughout the year? Do you have a risk management or risk minimization plan in place with your asset allocation? To know if you do, it really requires that you've done a risk assessment, that you know not only how much risk you can tolerate, what your preference is, but what your economic risk taking would allow. Meaning somebody in the same position as you financially, could you take more risk? So there's your feeling, and then there's the fact. And typically your portfolio needs to fall somewhere in between those two things. And you also need to think about risk versus volatility. And there are a couple ways to measure those two things. Risk is the maximum drawdown, in my mind, in a portfolio. So how much has that portfolio actually gone down historically when markets have dropped? That's your risk. That's how much money you have at risk at any one time. And that's versus standard deviation, which a lot of people conflate with risk, but standard deviation is really measuring volatility, how much the portfolio will fluctuate over time. Number 4, check out your fees and costs. Make sure that the expense ratios on any underlying ETFs or mutual funds are reasonable. Double check your transaction costs. Most places now don't have any, but if you are paying transaction costs, be sure that those are reasonable as well. Look, it's okay to pay fees. This is not a zero fee business in most cases, but you need to know who are you paying and why are you paying them. Number 5, tax implications. Make sure you're optimizing your portfolio for tax efficiency, considering the impact of capital gains rates and dividends, and then taking advantage of accounts like Roth IRAs to limit the amount of taxation either now or in the future based on whether you choose the Roth or the traditional version of it. Number 6, make sure your financial goals align. This probably ought to be first. Let's make sure that you have some goals to begin with so we know why we're investing the money and what we're trying to get out of this. Income needs is number 7. It's part of the income planning, and income planning is almost always and everywhere going to drive your investment planning, because we are, at the end of the day, sometime going to turn on these assets in order to provide you income. If that's not now, that is a different investment plan than it would be if it is now. So think about the income needs. Make sure that you have a plan for where and when you're going to draw income, and estimates on how much or how long those sources are going to last. Number 8, market conditions. Yes, you need to be aware of what's going on in the market. As I speak, we're waiting for an announcement from the Fed, which is going to make sure that you are aware of what is happening, so that when you open up your statement and you potentially see a loss, you're not surprised. You know that there are things going on in the market where it's been soft or it's been, downright terrible, so that you know what to expect and you aren't surprised. It's not to say that losses aren't going to happen or that market volatility is bad, but at least a baseline knowledge of what is going on in the market will help you keep your sanity. Number 9 is investment strategy. We need some consistency there. We need to ensure your investment strategy remains consistent across your entire financial plan. So what we're really trying to do here is work top down from a financial plan down to tax planning and then investment strategy. That investment strategy needs to take into account all of the other planning pieces that should have happened before this. And then number 10 is professional advice. If you're getting it, consider consulting with a financial advisor to personalize all of this and get a professional review of your investments to make sure that they are indeed aligning with all of the planning that you should be doing to get to the point where you would invest money. So regularly reviewing all these 10 aspects of your investment accounts can help you stay on track and achieve your financial objectives and make better decisions about your portfolio. So let's take a look at what a review might look like as you go through and take a look at some of these things. This is a checklist that I send to clients, and it begins with, do you have comprehensive planning? Do you have something that is guiding your investment objectives? Meaning, are you planning for a major purchase? Do you have an income plan in place? Are future generations part of that plan? And if so, have we gone in and done the administrative work to make sure that the accounts are going to pass to them in an efficient manner? Have you established what your risk tolerance is and why it is that way? And have you established that that risk tolerance is going to allow you to grow your funds at a sufficient rate to fund future income needs? So only by planning, only by sitting down and doing a comprehensive plan that includes income, tax, and investment can you even get to the point where you can answer these questions intelligently. From there, I actually skip the investment issues for now and come down to tax issues. Are you trying to minimize your tax liability? I don't know anybody in my practice who's ever answered no to that. So limiting taxes is a normal business practice day in and day out. And then once you've aligned your future income needs and your planning pieces, well, now we can start to look at the asset allocation that you would need to match those plans. And we can take a look at the types of accounts that you own, taxable, tax deferred, and tax-free, and make sure that your income is going to come from places that optimize your ability to get the income in the most tax efficient manner. From there, we can continue on with some of the investment issues. If you are working with a professional, you should have a baseline knowledge of what the selection criteria are for the investments, how do they monitor, and how do they present you with performance. If you're doing it on your own, I highly recommend writing out your investment plan and how you do these things, and then updating that as time goes on. Are you planning to take distributions? That's always the number one question. It's part of the planning. It's part of the overall understanding of where your income is going to come from, but things pop up over time. So short term, you may need to take some distributions you hadn't planned on. Well, where are you going to take those funds from? It's an important piece to understand. And then, do you have anything that you need to think about strategically that you want to see happen during periods of market decline? Do you have a strategy in place to harness your emotions, but also to limit your losses if that's part of your strategy? And then again, if you're working with somebody, does the frequency of any account reviews or monitoring need to be updated? Is that something that, based on your experience, you need more of or less of? That should be customizable to your situation if you're working with somebody. And if you're not working with somebody, I still highly recommend doing scheduled reviews, putting them on your calendar and making sure you're going in and checking off the items, even in this particular checklist, so that you know that you've covered everything you need to cover and that your investments are matching the overall planning that you've done. Well, my fellow historians, that is all for this week. Check out my book, History Lessons for the Modern Investor. That's still available on Amazon.com. And be sure to do all the social stuff, like this episode. Follow us wherever you see or hear your podcasts. We're available on Substack, Spotify, Apple Podcasts, or YouTube. Until next week, when we'll take another rollicking romp through the past and make an investment in your future with History Lessons for the Modern Investor.
See you next week.